In this section, we're going to review the main market indices. By observing the share prices, we can tell what stocks have increased, decreased, or remain unchanged in price. However, is there a way for us to determine how a specific group, such as banking, or the industrial sectors, or the market as a whole, will behave? Well, fortunately there is. The tools we use are called market indices. A market index is a measurement of behavior for either a group of stocks or for those of an entire market. A market index is calculated as the rule with the help of statistical weighting. 4 types of weighting are applied: price weighting, value weighting, equal weighting, and geometric weighting. Now let's look at some different ways to calculate an index using simple exercises. Let's assume we need to calculate an index which is comprised of 3 stocks, A, B, and C. For the first day's calculation, day 1, share prices for A, B, and C are the following: A, $10, B, $20, and C, $30. The index based on price weighting is calculated using the following formula, where S1 equals price of stock A, S2 equals price of stock B, etc., up to Sn, which is the price of the last share included in the index, and D equals the divisor. Now, if the shares were not exposed to splitting, remember that splitting of shares is a form of payment of dividends, the divisor would always equal the number of shares in an index. As the splitting of the shares results in a change in price, the value of the divisor must be adjusted each time. So on day 1, our index will equal 20. On the following day, day 2, a split on stock A occurs with a 1-to-2 ratio. And let's say a split on stock C occurs with a 1-to-3 ratio. At the end of day 2 session, the following prices are posted. A is at 6, B is at 21, and C is at 11. If we didn't change the divisor, the value of the index would be calculated using a more complex formula. However, if we use this formula to calculate an index containing numerous stocks, after several splits it becomes cumbersome and almost useless. That's why we will stick with the basic formula, which allows us to change the divisor. In fact, this is necessary to solve this equation. This formula gives us a new divisor, equal to 1.7273. Therefore, after 2 splits, the new divisor will equal this instead of 3. Now let's calculate our index for another day, day 3. Let's say there were no more splits, and at the close, the prices were the following. A was at 7, B at 20, and C at 10. So our index for day 3 will be equal to 21.42. As a note, when calculating an index, one does not begin with the number 0, but from a certain level, such as 100. So applying this to our example, we obtain the following data. This is how the price-weighted indices are calculated. The most famous price-weighted indices are those of the Dow Jones Group. These were developed by the founder of the Dow Jones Company, Charles Dow. This group is comprised of 3 indices. The first, the Dow Jones Industrial Average. This originally included 30 companies from the industrial sector. Currently, it includes a slightly more diversified selection of blue chips. The second, the Dow Jones Transportation Average, which follows the performance of 20 transportation companies. And finally, the Dow Jones Utilities Average. This is based on 15 companies providing public utilities. The popularity of the Dow Jones indices is primarily rooted in tradition. The principle of price weighting cannot be considered as the best method of calculation, because the number of shares included in an index is not taken into account. As a result, the higher price stocks outweigh those having a lower price, without regard for their level of capitalization. This is why the modern indices are based on the principle of value weighting, which takes into account the capitalization of stocks. For an explanation of valuating, let's return to our example. Assuming that in the market the number of shares for our respective stocks are as follows. Their initial capitalization will be 1 million for stock A, 4 million for stock B, and 9 million for stock C. And again, the way we find the capitalization is by taking the number of shares for each respective company, A, B, and C, and multiply it by their current market value. We calculate a value-weighted index as follows. Calculation of day 1's capitalization. The value of the index for day 1 is given as 100. And we calculate day 2 capitalization with splits included. The capitalization of day 2 is divided by that of day 1, and is then multiplied by 100, which is the starting value of the index. So our starting value will be 109.29. The procedure is repeated for all subsequent days. So for day 3, our value is at 102.86. The table of our index will look like this. Day 1, 100. Day 2, 109.29. And day 3, 102.86. The majority of modern market indices are based on valuating. The most famous index of this type is the Standard & Poor's 500, which includes 500 companies on the American market with the greatest capitalization. The Standard & Poor's 500 index takes into account 400 industrial companies, 40 companies from the utility sector, 40 financial companies, and 20 transportation companies. In the addendum, you'll find a complete list of the companies included in the Standard & Poor's 500 index. There are also other indices based on valuating, such as the NASDAQ Composite, which is based on approximately 5,000 stocks traded over the counter. The New York Stock Exchange Composite, which is comprised of practically all the stocks traded on the New York Stock Exchange, representing about 2,300 companies. The Russell 2000 and 1000 indices are calculated by the Frank Russell Company in Tacoma, Washington. The Russell 1000 includes the 1,000 most highly capitalized American companies. The Russell 2000 is based on so-called small-cap companies. There are companies with small capitalization, which means they have a capitalization of less than $380 million. And the Wilshire 5000 Index, which tracks the greatest number of companies of all the indices. These companies are traded on the New York Stock Exchange, Amex, and NASDAQ. Now we're going to look at equal and geometric weighting. These two types of market indices stand independently. They're calculated by the company Value Line. The first index is called the Value Line Composite Index. The second is called the Value Line Geometric Index. The Value Line indices track more than 1,700 companies. Their calculation is based on equal amounts of investment in various securities. It should be obvious that one can buy a greater number of inexpensive shares than that of expensive ones. For this reason, the Value Line Index is more sensitive to the fluctuations of the less costly securities. The arithmetic index is calculated as follows. First, we calculate the change in price as compared with the previous day. So the calculation for day 2, including splits, is as follows. 1.2 for stock A, 1.05 for stock B, and 1.10 for stock C. Next, we calculate the arithmetic mean of the relative changes in price, giving us a value of 1.1167. And finally, we multiply the index's starting value of, for example, 100 by the arithmetic mean, which gives us the value of the index for day 2 of 111.67. This procedure is repeated for each subsequent day. So for day 3, we get the value of 1.0094. The total value for our index is 112.72 for day 3. So our table will look like this. Day 1, 100, day 2, 111.67, and day 3, 112.72. The calculation for the value line geometric index is similar to the arithmetic. However, instead of using the arithmetic mean value, the geometric mean value is used. The geometric mean for relative price changes is calculated as follows: S1 times S2, etc. times Sn. S1 equaling the relative change in price of the first stock, S2 the relative change in price of the second stock, Sn the relative change in price of the last stock. So in our example, the geometric mean of the relative price changes for day 2 is calculated, giving us a value of 1.1149. We multiply this times our starting value of 100, giving us day 2's value of 111.49. The same calculations are used for day 3, giving us a total of 1.0034. But now in this case, we take the value of day 2, 111.49, and multiply it times 1.0034, giving us day 3's value of 111.87. So our table for this index will look like this. Day 1, 100, day 2, 111.49, and day 3, 111.87. Now let's take a look at all of our indices side by side. We can see that all the indices react to the rising and falling of stock prices, but they vary dramatically in their representation of these changes. These variations can be seen in the day 3 listing. You'll notice that the price and value weighted indices show a decline, while the equal and geometric weighted indices show an increase. Why this difference? Well, the relatively inexpensive stock, stock A, which increased 17% from $6 to $7, is to blame. You should remember that the value line indices, when calculated, are very susceptible to the influence of inexpensive securities. So, what can we take away from our review of these indices? Well, one primary point. The art of trading is based on the ability to take into account the various factors influencing the market. Therefore, it's very important to follow not only the Dow Jones indices, but others as well. And further, it's equally as important to take into account the principles underlying each index, namely the weighting.